Here we are again. Welcome to Biz with Rich. I'm Rich, editor of Under the Radar Report. Boy, it's great to be back. I'll get to the beer later. Well, I might just crack it, but anyway. Once again, the start of the show of the stocks. Let's crack it. Here's to the stocks. Ooh, heavy. In this week's report, we cover 4 uranium developers and rank them, as well as a new stock you might not have heard of. That's right, one that's under the radar. Well, the number 1 ranking goes to the ASX flagbearer Paladin Energy. Doubled our money in less than in just over a year. Toast to Paladin. Always a good start in the ranking system. Not sure about this beer, but anyway, let's keep going. We also like other stocks. The other uranium developers that have varying degrees of risk. Bannerman, Boss, Lotus. Read our report is my advice. We tell you what's good and what's bad and everything in between. But the real excitement comes in the form of an enrichment specialist. That's right. Downstream. It's a new stock we're covering. This stock's on a tear. I kid you not. Worth checking out. Oh, God. Well, we like the nuclear theme, that's for sure. Like I said last week, the energy space is hotting up. No one can deny that. Getting carbon emissions down, providing baseload power. Well, you need nuclear to be a part of that equation, don't you? Within the nuclear space, what's really hot at the moment is the small modular reactors, which is where this stock comes in. The world's in need of flexibility. You want to own stocks that can play a part in that. So let's move on in the energy space to oil. I mean, this is interesting. I mean, this is also interesting. I mean, basically, the oil price has fallen out of bed in the past few months. Since June, basically. It's been slipping, sliding down. Next week, we discuss why and the opportunities at the small end. I mean, and this includes gas. Basically, it's not the same as oil, but its price is somewhat linked through LNG prices. So that's interesting in itself. But, it's faced possibly even more disruption than oil. But, or certainly in recent times. But 2 of the small caps that I've mentioned in this space, in the past have been Cooper Energy, Karoon, and Karoon Energy. Both are delivering big returns. Why? Because of that flexibility I mentioned. Cooper's servicing the eastern market of Australia, to great effect. It's had some problems, who could deny that? But, there's definitely a supply shortage in gas in Australia, and especially in the east, where they've had that record level of LNG production up at Gladstone. Karoon, on the other hand, is growing oil production through its projects in Brazil. So that's what you get from these little companies. You get, leverage off a smaller asset base. That's what I keep saying. Small caps is it. But I tell you, with that leverage comes increased risk. So that's why we advocate owning a number of them. Minimum probably 7. I mean, theoretically that gives you diversification benefits. Probably 15 to let you sleep at night. I mean, who's not interested in sleeping? Let's move on. Not sure about this beer. It's a funky label. Doesn't match its taste. But like the stocks I've just mentioned really do gap up and down. We've seen that with nuclear in particular. But they gap up and down on the basis of commodity price moves. You want more protection than that. So you need to be buying small caps with the technology edge, industrial space, manufacturing, you name it. Disruptors take many forms. That's why we cover over 100 of them. But I often get asked, what part should blue chips play? Should I even own the blue chips? Well, this week's blue chip report's a cracker out today. And we have a long section about the market and the individual sectors within the market, as well as stock analysis. But I interview the portfolio manager of our blue chip portfolio, Sam Ferraro, who's an economist by training and in the midst of his completing his doctorate, rocket science stuff, busy boy, so we was lucky to get some time with him. But he highlighted basically that the 10-year Treasury bond yield is at or near decade highs at 3.3%. So that's a fact you can't ignore. I mean, that is a big deal when it comes to currency moves. It's all going on. That's where the big dogs are. Like $33 trillion, I think, is what the value of the US Treasuries is, and that's just a 10-year bond. I mean, that's where the big dogs play. So you have to take a lot of notice of what that's doing, and that's at record highs. So there's been big sell-offs in the bonds market as inflation fears ramp up. But the crux of Sam's thinking, as an investor, as a portfolio manager, is firstly that as these interest rates rise, stock picking is paramount. It becomes even more important, which is what we've been saying. But what he's also doing is reducing our portfolio's beta. So what beta means is a stock or a portfolio's sensitivity to the market. So basically, he's trying to hedge market risk. So this does mean buying small caps, because many small caps aren't correlated to the market, but it also means buying defensive stocks, like that produce earnings and dividends that happen more consistently, whatever the economic conditions. So this week's blue chip, we talk a lot about which stocks you should be buying. The beer. Well, here we are. Garbage project. Oh, that was a misspeak. Garage project. I think it's New Zealand. Well, it's pretty funky looking. Look at that. What's it called? Ocean of Oneness. Crikey. I'm not sure about this one. Zero carbon. Oh, well, it's not zero alcohol, at least. It's got something going for it. Anyway, what's coming up? As I said, we've got the in-depth report coming up on oil and gas that include lots of small caps exposed to the sector, lots more Karoons and Cooper Energies. Plus, we've got a 100+ research rundown, which gives you all the small caps we cover, to give you the length and breadth of how you can diversify your portfolios, with all our recommendations, investment metrics, the works. So then we get on to our best buys. Money never sleeps. Cheers.